Welcome back to U.S. Farm Report this weekend. Chip Nellinger and John Payne joining us. All right, let's backtrack to the beginning of this week when we saw that strike on the bridge, the Black Sea ports also seeing some chaos there. When you look at what happened Monday, we really didn't see commodity markets respond immediately. Why was that, Chip?
Yeah, I think that there's been so much back and forth about whether the Black Sea grain corridor is going to be renewed by Russia. It is, it isn't. The market got a little bit weary. And then Russia came out and said, no, we are not going to renew that. And the market didn't react to that because I think, they thought maybe that there was still a chance. But I think by, the middle of the week, it was apparent that Russia was playing hardball. They started attacking, some Ukrainian ports and then, said, yes, for sure. Not only is the Black Sea Agreement done for, but we may look and fire upon some of these ships that are moving into the Black Sea towards Ukraine. And that really is what spooked the markets. It's got the algos, coming into the long side on the headline. And the funds have been having huge short positions in the wheat market. We're a little bit slow to react, and they continue to buy every break and are kind of caught short right now into a very volatile situation in that Ukraine Black Sea area.
So when you look strictly at that news, John, is it mostly wheat that is responding positively and the momentum we've seen in corn and soybeans is due to something else, or what is that the big driver of?
I think corn and soybeans have their own dynamic going on right now with the U.S. weather story. So that certainly shouldn't be ignored. But I think the rally we've seen really is upon kind of the musical chairs that's going to be played here in regards to who's getting shorted with supply. So on the global balance sheets, the loss of a Ukraine crop, at least the export terminals, isn't a huge deal. What is a huge deal is if we're going to lack any commercial shipments at all in the Black Sea. And so what developed after the initial attack on the Kerch Strait was Putin said, hey, we're done. And anything that's moving through the Black Sea to these Ukrainian ports is going to be seen as an enemy. So they've essentially scuttled the reports in Odessa now, and those are unusable. And so there's one other port down in the southern part of Ukraine that'll be open. And then, of course, you have the Constantinople ports that are more in the southeastern part of the Black Sea. So at this point, I think that's the uncertain event. It's like, how's this going to move forward? And you've got a little bit of a price action relative to 2022. I don't see that happening again. I don't think we're going to see $14 Chicago wheat, but I think you do have to got a knee-jerk reaction here by a lot of short sellers to just get out. And I think that's what's happened the last couple of days.
Prior to this, Chip, I heard some analysts say, listen, because of the big crop in Brazil, because of world supplies, really, we don't necessarily need all of that grain out of the Black Sea corridor. And we're going to be okay, even if some things develop there. Is that not the case? I mean, why are markets responding so much to this news?
Well, it is the case. I think, on the one hand, Ukraine production is going to be way less than a year ago, likely. Their planted acreage continues to drop. So they were really hampered to begin with. In my mind, it's more about Russia, and they supposedly have a big crop. That Black Sea, grain corridor probably benefited Russia as much as it did Ukraine. And now if that's going to really slow, and there's been talk that Russia is going to keep some of that wheat off the market for an internal supply reserve, so to speak. That really is maybe the biggest picture is, will Russia continue to supply the world now that Black Sea is closed? Certainly India and China have been big recipients and big benefactors of that. And so that really is the big question here. And, I think to John's point earlier, the world wheat supplies continue to slowly shrink. And that was somewhat lost on the market this last, USDA report. The wheat supply situation continues to slowly shrink up a little bit. And now you're talking about some potential shortfalls in the Chinese wheat crop with some drought conditions there. And so it's a little bit of a different situation now that, the Black Sea is officially closed.
All right, John, you mentioned weather. And as we look at the forecast over the next, 7 days, it doesn't look like much rainfall. We are going to get some extreme heat. If we get rainfall, what does it mean for these markets? If we don't, what does it mean?
Well, I think the move we've seen in the last days, whatever the cause of it, we've seen insurance costs for short-term options skyrocket. I think up almost 100% on the volatility costs for some of these out-of-the-money options. So that is kind of a front-running event where if this weather would really turn dry in August, you could see some short covering, obviously. But I think the funds have moved out to a general degree. it's really comes down to beans. I don't think corn is that threatening. It's a bean crop. The lack of acres, puts a lot of stress on whatever we're going to have. The crush numbers, while they're smaller, they're still stout, and crush margins are really good. So a break in bean price isn't going to help unless you get oil and meal falling with it. And right now you've got meal up and oil, front month oil trading near 70. So all in all, crush margins are really good. It's going to take more price to break the end user.
Well, weather definitely is what the markets are watching right now. We're going to get Chip's thoughts on that later on U.S. Farm Report. Please stay with us.